Monaco 64, home of alternative economics and contrarian views. So today is Monday, January 15th, 2024. And Clive is on today because we're going to talk about the Federal Reserve and whether it really has a title to any gold and whether they're actually desperate and fighting for survival with the fact that their balance sheet is looking more and more precarious as bond yields rise. Clive, welcome.
Good morning, Mario. Thank you very much for having me on your show.
You're welcome. And it's always great to have you on the show. Some people were asking yesterday during the live stream where you were, and I said, well, you're going to be on this morning. So, yeah, Clive, I'll let you start talking about the Federal Reserve and also the Gold Reserve Act of 1934.
Great. So a lot of people say the Federal Reserve's got the gold. It's valued at $45 an ounce. They could easily revalue it up to present value and solve all their financial problems. And just to start off with, what's the financial problem that the Federal Reserve has got? They're losing money hand over the fist since they started raising interest rates. And the reason they're losing money is the interest rate they're paying their depositors, that is the banks and the money market funds who deposit money with the Federal Reserve, is higher than the interest they're earning on their portfolio of bonds that they bought 5 or 10 or more years ago. So those bonds are yielding the interest rates of 3, 4, 5, 10 years ago, when the interest rates were effectively the Fed funds rate was 0.25% and the rate on the bonds was 1 or 2 or 3 or 2.5%. And they're paying out 4.5 or 5% on their deposits. So they're losing money, have been losing money for several months. They lost more than 100 billion so far. But the other way they're losing money is their portfolio of bonds has fallen in value. And as at the last audit date, which was, I think, 30th of September, I think, they were down about over $1 trillion on their portfolio of bonds. Now, to put that in perspective, the capital and reserves of the Federal Reserve are something like 40 billion, and they've lost on an ongoing basis more than 100 billion in terms of current losses, paying out more interest than they're earning, and they've lost $1 trillion, that's 10 times that amount, simply due to the fall in the value of their bonds. So some people say, well, they could revalue their gold. And if they were to revalue their gold, which I'm going to get to the point that they don't actually have any gold, but if they were to revalue it, that would perhaps add 500 billion to the balance sheet or to their reserves, which still wouldn't cover the losses, but it would certainly cover the current loss that they're making in terms of paying out more interest than they're earning. But the question is, do they have the gold? And I've gone back to the Gold Reserve Act of 1934, and I'm just going to find the right page to show you the relevant text on that, if you bear with me. But basically, what happened in that act was the Treasury took away the gold which belonged to the Federal Reserve and exchanged it for a gold account, which is payable in lawful currency. And lawful currency basically means in US dollars. So, and it's quite clear that when you read the Act of 1934, that the gold became the property of the United States Treasury, or the government, if you like, and the profit on that gold accrued to the Treasury, not to the Federal Reserve. But I'm just looking here if I can bring that up. Can we share a screen, Mario? Mario, can I share a screen there?
Sure, that you can.
So share screen, let's just do that. Now, I hope you can see that.
Yeah. Yeah, we can see it now.
Right, I'll just read the relevant part. It reads here, upon approval of this act, all right, title, and interest, and every claim of the Federal Reserve Board, of every Federal Reserve Bank, and of every Federal Reserve agent in and to any and all gold coin and gold bullion shall pass to and are hereby vested in the United States, and in payment, therefore, credits in an equivalent amounts in dollars are hereby established in the Treasury, etc. So basically, I'll come off that page now. If you read that, the ownership of that gold passed at that point to the Treasury. Now, there is a further comment which I'll get to, which is I'll just put up on the screen again.
Yeah.
Actually, share
Can
screen.
I just add one thing, Clive? A lot of that gold that the Federal Reserve had, part of it was confiscated from the public, and part of it, I guess, was some of the gold that the Fed held for itself, the regional banks. So yeah, I would say that the United States basically legally stole a lot of that gold, from the people and from the private Federal Reserve banks. I'm not like trying to help the Fed here, but yeah, that's really interesting.
That's correct, Mario. There was a two-step process. In 1933, President Roosevelt passed a declaration or an order whereby every American citizen was ordered to hand in all his gold to the Federal Reserve. So in 1933, the Federal Reserve got the gold and was basically authorized to issue, or was issuing, new currency in paper form to the public at large. But in 1934, the Treasury, which needed that gold to pay their bills and so forth, they sequestered the gold from the Federal Reserve under the act I just described. And I just go to one more section, which you can see on the shared screen. You can see the shared screen here, and I'll read it to you, but it's quite clear this gold does belong to the Treasury now. Under the Gold Reserve Act of 1934, signed by the President on Tuesday, this is from the New York Times, by the way, on Tuesday, January the 30th, title to the entire stock of monetary gold in the United States, including gold coin and gold bullion, heretofore held by the Federal Reserve banks, and the claim on the gold in the Treasury, represented by gold certificates, is vested in the United States government. And the profit from the reduction of the gold content of the dollar, because you may remember the day before that, this is what happened the subsequent day. The day after they confiscated the gold, they revalued gold at a higher price, or
Yeah, I
reduced.
think it wasn't the day after they confiscated the gold. It was through this act. They
Yes, you're right.
valued from
In 19,
$20.67 to 35.
Yep, that was in 1934. The day, uh, basically, when I said the day after they confiscated the gold, I meant the day after they confiscated the gold from the Federal Reserve, not when they confiscated it
Oh
from the
yeah. Well,
public, which was a
yeah.
year earlier.
Yeah, it
So a
was.
day after they confiscated the gold from the Federal Reserve and gave the Federal Reserve gold certificates payable in lawful currency, the next day they reduced the amount of amount of gold in lawful currency by about half.
Yeah.
And that is where we see the next line, which says, and the profit from the reduction of the gold content of the dollar made effective by today's proclamation, that would be on Wednesday, the day after they'd confiscated the gold, made effective by today, accrues to the United States Treasury. Of this profit, $2 billion under the terms of the Gold Reserve Act and today's proclamation constitute a stabilization fund. The balance will be converted to the general fund of the Treasury. So at that point, all the gold which was owned by the Federal Reserve had been taken from the Federal Reserve in favor of the Treasury, and they had received lawful currency, which did technically at that time contain a certain amount of gold. The next day, they devalued the lawful currency by roughly half, so it contained half the amount of gold. And as of today, and it actually happened in 1971, the gold content of the dollar was completely removed by Nixon, so the gold content of the dollar is zero. So what that means is the Treasury owns gold certificates which are payable in lawful currency, i.e., at the face value, the same number of dollars as they got, and they are not payable in gold because the dollar no longer contains any gold at all.
Yeah.
So the Treasury doesn't have any gold. Not the Treasury, the Federal Reserve no
Yeah.
longer has any gold.
Yeah, that's right. So, what do you think is the repercussion of that, and how do you think it's gonna, it could affect the Federal Reserve going forward if, as we think, interest rates and bond yields continue rising? Do you think the Federal Reserve is fighting for survival? Is this like a backdoor towards really ruining the Federal Reserve, or do you think the Treasury will step in and help them out?
Yes, yes, and yes. But let me talk about first of all the scenario if nothing happens, and then what will happen to solve the problem. Uh, Under the present situation, the Federal Reserve, if it keeps interest rates high, it will continue to lose money, and the reason is for the simple reason that I explained earlier. It's going to continue to lose money, and there will come a point, probably sometime in the distant future, when it would completely run out of the ability to repay its depositors. Now, you may say that they can print money at will, but they can't really print money unless the way they print money is to buy treasuries issued by the US government, so that they can't create a liability by printing money unless they have a corresponding asset. So that's not going to work. But there is a solution, and I'm going to get to what they will do. What I think will happen is, first of all, they will most likely lower the short-term interest rates in the hope that the long-term rates will follow. Now, it's not an absolute guarantee that the long-term rates will follow, because the US Treasury has a very large borrowing need because they're running large deficits. The deficits are running at the rate of about 2 trillion a year, or they will be running at around 2 trillion a year according to their own budget. And that means they have to increase and keep increasing the amount they're borrowing. And at some point, the public at large could get indigestion and say, we're not buying any more treasuries at the old rate, we want a higher rate. So it could be that the rate on treasury bonds are rising, even though the Federal Reserve is trying to help things out by lowering the short-term interest rates. So what happens then? It could be that the Federal Reserve voluntarily does what it did after the banking crisis, and voluntarily does after in the COVID pandemic, and that is to start buying treasuries to lower the interest rate on treasuries. That's called yield curve control. They say they won't, because they're in the middle of quantitative tightening, which means they're trying to reduce their balance sheet, which means they're letting some of the treasuries they own run off, and they're not reinvesting into treasuries. So they say they won't, but they may find that politically they have no choice, particularly if the economy starts to stall, or particularly if the Treasury is having trouble funding its borrowing program. Now, the question would be, will they cave into pressure, or will they have no choice but to do it by order of the government? I think they will cave into the pressure. I think Elizabeth Warren will say, Janet Yellen will say, come on, guys, you've got to help us out here. We're having trouble funding. We want you to start buying treasuries. And that would be a bit of a pivot, because it basically means the balance sheet of the Federal Reserve is now expanding again. It's quantitative easing starting all over again, which you know is inflationary. That, Mario, you'll know is going to be very, very good for gold if and when it happens. But what if the Federal Reserve says, no, I mean, we're independent. We're not, the government can't tell us what to do. We're an independent organization, and we're going to do what's best for sound money. And sound money means we keep interest rates tight. We don't expand our balance sheet. We don't expand the money supply. And we're not going to do as we're told. Well, it's entirely possible that Congress could pass a law obliging the Federal Reserve to buy treasuries. And the precedent for that was in exactly the same act as we looked at, the Gold Reserve Act of 1934, because one of the provisions, which I didn't show you, was basically an order to the Federal Reserve to buy several $billion of treasuries. So it's happened before. It could happen again. So, in my opinion, whether the Treasury whether the Federal Reserve likes it or not, they are either going to cave into political pressure or they will be forced to start buying treasuries at the point when it becomes more difficult for the Treasury to fund the government's borrowing program. And when that happens, I think all hell is going to break loose on the financial markets. I think the dollar is going to collapse. When I say collapse, I mean it will go down, but it will be reported as a collapse. Newspapers like to over-dramatize these things, but certainly the value of the dollar will drop on international exchanges. I think that obviously that will stabilize Treasury prices and therefore stop the yields from rising. And of course, the value of tangible assets, such as gold, will rise in reaction to that. When that happens, how it happens, I don't know, but my guess is it's going to happen in the next 12 months and most likely before the general election in November.
Yeah, some people,
The presidential election, I mean.
yeah, some people argue that in 1934, when the Treasury passed, the United States passed the Gold Reserve Act, that basically the Treasury took over the Federal Reserve, and that they're running together. So the Fed isn't really that independent. What about the two questions. First, the gold at Fort Knox, is it still there or is it encumbered, through leases? And also, the New York Fed has a gold room. And I even had a client back when I was in the financial markets. He worked for a big New York bank. I won't say the name, but I could actually, Citibank, and he was in the Treasury and he used to deal through me in the futures market. And he was a really nice guy, and he used to tell me that he had to go um, regularly to the New York Fed to inspect the gold room. And I always thought it was weird why a guy from the Treasury at Citibank or Citigroup would go look at the gold room at the New York Fed. Maybe it's because Citigroup has part of the ownership of the New York Fed. But I'll let you answer the two questions, though, because the gold at the New York Fed is supposed to be held for foreign institutions. Should they be worried about having that gold there?
So there's first question is the gold really there at all? My understanding is that it's not been audited and much of it has not been tested because it arrived there before testing techniques existed. And I don't think there's a lot of enthusiasm by the Federal Reserve or the Treasury to have that gold tested, because it would be pretty disastrous if it turned out that some of the gold wasn't really real. You can imagine the effect on the global markets if it's suddenly they don't own what they think they own. So let's assume that it's all for real. The next question is there enough gold there to meet the United States obligation to foreign depositors of gold? And so let's talk about that. Well, you may recollect that up until 1971, foreign governments could redeem their dollars for the gold, because if we go back what I said a bit earlier, each dollar contained a certain number of grains of gold. I can't remember the figure. Was it 28? Something like 28 grains of gold. But basically, that was equivalent to $45 an ounce. Previously $35 an ounce, and before that $20 an ounce, roughly. So back in 1971, there were various governments around the world who were mulling over asking for their gold back, or rather changing their dollars, which were the same as gold, back into the gold which was owed to them. So the French were basically the catalyst for this. They'd sailed their battleship into New York Harbor by arrangement to pick up their gold, because they were going to send the US government their dollars and get their gold and ship it back to France. And basically Nixon or whoever was in charge at the time looked at the amount of gold they had in reserves and realized they couldn't give everybody their gold because there wasn't enough to go around. So that's when Nixon had his proclamation in 1971, which said dollars are no longer redeemable in gold, they're only redeemable in dollars. and the French had to take their ship away empty because there was nothing, they couldn't get their gold. Now, that was obviously the conversion of dollar balances into gold, and the dollar balances were a legal entitlement to a certain amount of gold. Today, foreign governments have got physical gold deposited with the United States. So it's not actually dollar balances, it's got physical gold bars. And the question is, are they all still there, and can they get them back? Well, nobody really knows that for sure, but the only way to test it would be for foreign governments to say, can we have it, please? Um, I suppose it is there, but I don't think there's any concrete evidence that is published that we can see to prove that. So I'd be a bit nervous if I was a foreign government, and I'd certainly be thinking about whether I want to keep too much gold in the United States. But there is a valid reason to keep gold in the United States, and that is the risk of invasion. If you're a country somewhere on the planet and you fear that one of your neighbors might invade you, and they might invade you and take your gold, well, it's a good idea to have some gold outside your own country and park some in London, some in Zurich, and some in New York. That kind of makes sense. So you probably don't want to ask for or have zero gold deposit overseas and have it all back home. But it does make sense to think carefully about how much you keep close to home and how much you keep in New York, bearing in mind the risk that you might not be able to get it back, given that what happened in 1971.
Yeah, and the other thing is Germany, I think it was back in 2013 or something. They asked the New York Fed for a lot of their gold back, and it took years for them to get it back. And people might wonder why did it take years? You know, they could just ship it really quickly. I think it's because a lot of the gold they hold at the New York Fed, which is different from the Fort Knox gold, a lot of it is like leased out many times over through the bullion banks. So if they repatriate that really quickly, they drive the price of gold to, you know, unimaginable heights, in my opinion, because they'd have to cover all their shorts and call that gold back. Uh, as to your argument that it's good to have a little bit of gold in the United States, or even the French. I think they sent a lot of their gold to Canada, uh, just as the Germans were invading. I think, in World War II, they shipped a lot of gold to, I think it was Montreal or Ottawa. Yeah, that is a good argument, but I mean, there's a lot of people who think the United States now doesn't want, is not looking at for the best interest of its allies. Of course, it should look after its own interests, but some people argue that the explosion, the destruction of that Nord Stream 2 pipeline was the United States was behind it. And because Joe Biden said some months before, when asked by a reporter, about Nord Stream 2, he said, "Believe me, we can stop that." And
Mhm.
the fact that they didn't want peace, between Russia and Ukraine, and made sure that the Europe wouldn't get all the energy it needed from Russia, especially Germany. Germany had a big relationship. It's been buying natural gas from the Russians even before the Soviet Union collapsed. A lot of the pipelines were built in the 60s when the Soviet Union was around. So I personally think the any foreign institution, central bank or whatever that has some gold with the New York Fed should be worried about it. And I think in Germany, a lot of people were asking about that, and that's why, the public was saying, why is our gold being kept in New York? And that's why they repatriated it, and they even did a book, the Bundesbank, Germany's Gold, which I recommend.
Mhm.
They talk about that topic. And also the gold in London. There's a lot of countries that keep, I think, about 5,000 tons of gold at the Bank of England. And Venezuela, of course, Hugo Chavez, he repatriated like 100 tons back in 2011. And they sent it right away. from London to Caracas. They didn't wait that long, and at that time, gold went from 1400 in the summer of 2011 all the way up to 1900. I think that was part of the effect of that 100 tons of repatriation. So, can you imagine if a country like Germany wants 500 and others want a few? I think it would drive gold a lot higher.
Yeah, I mean, there is some talk at the moment about confiscation of the gold held by foreign institutions for Russia. Um, I think that would be a very bad idea because one crime does not justify another one. Because basically, if you take Russia's gold, that's theft. It's not that I approve of anything that Russia has done, but so it's one thing to say you can't mobilize your bank deposits or you can't mobilize your gold. It's a completely another one to say, well, now it's ours. That's because that's one, that's theft. If that was to happen, and if those proposals go through, then I think many, many countries around the world will definitely repatriate their gold, saying there is a real risk that we'll find our gold literally stolen from us in a situation where we've got into a disagreement with one of the countries which is holding the gold for us.
Yeah, so is that to do with the 300 billion in reserves that Russia has outside? I guess
Yeah.
they do have a little bit of gold in that. I thought they'd keep all their gold in Russia, but I
So
guess
yeah, it's reserves. I
yeah.
said gold, but
Yeah. I mean, that's the problem too. I mean, it's interesting because in 1938, and it goes to show how property, and the rule of law has changed so much, and I think it's in danger. In 1938, when the Germans invaded Czechoslovakia, the first thing they did was go to the central bank in Prague to take the gold, and they found out from the central bankers that Czechoslovakia also had gold at the BIS, Bank for International Settlements, and that gold was held at the Bank of England. And Montague Norman, who was the governor of the Bank of England, he transferred that gold from Czechoslovakia in London in their BIS account to Germany. So and the Germans, the Allies, they were all working together at the BIS during the war, transferring, financing each other. The U.S. didn't have a Fed official, but the president of the BIS uh, Mc- uh, was an American. I forgot his name now, and he was, a New York banker. So it's interesting that back then, and I'm not like condoning the fact that the Allies dealt with the Germans during the war at the BIS, but the bankers respected private property, and now it seems like they don't.
well, Mike Mario, you've read the book The Great Taking, and if there's any truth in that, we all have to be very wary of who your counterparty is, who your custodian is, if you hold any kind of asset, because there is a danger that in certain circumstances you might not get it back.
Yeah, and what do you think about like the gold price right now? I know you don't look at technicals, and with that, maybe we could look at the markets. I know there's a holiday in the U.S. Today. It's a Martin Luther King Day. I don't think Treasuries would be trading, but I'm going to share here a screen where I look at the prices here. So as you can see, it's just after 9 a.m. London. We've got gold. It's up again. It's up about $6. I think on Friday it got up to 62. So and silver is a little higher, but we're starting to see the stock market come off. So
Well, it's quite interesting that the digital gold of Bitcoin is dropping in price in the last day or two, at the same time as the gold price is rising.
yeah,
Obviously, that will be pleasing some of the gold bulls like Peter Schiff. But I
yeah,
think I think realistically speaking, the sentiment towards gold has now shifted, and people are uh, we're now in a net accumulation phase of gold, not only from foreign central banks who are buying gold hand over fist, but the public at large are starting to wake up. And I'm coming across more and more people who are just starting to buy their very first gold coin. And I think that trend is going to continue.
Yeah, and we've got here crude oil. It's down a little bit today. WTI is down a third. Brent down about a third as well. And I usually look at copper. You know, copper has been, some people say that copper is a indication for the economy. And it's been a while since it's been able to get back above $4, the high grade copper. As you can see here, it's big resistance. Um, and the currencies as well pretty quiet today. And the Swiss franc, yeah, I mean, when I was in Switzerland for Christmas, Swiss franc traded almost down to 83, but the dollar seems to have rebounded a little bit here. It's at 85.34. Any views there, Clive?
The dollar probably will be the last one to fall. I mean, it's still possible to change things into well, it's still possible. You can change things, money, anything you like into dollars, but I think it's going down with the euro, with the pound, and it'll probably be the last man standing. But it's definitely worth a lot less. I mean, we know that everything you buy in the United States costs a lot more than it did 10 or 20 years ago. And the reason is not because things are more valuable in the United States, it's because there's more dollars out there and they're worth less.
Yeah, Clive, one thing I noticed last week, and I think, yeah, the Treasury market today is closed because it's a federal holiday. And for those people who think it only trades during US hours, it's not true. It's like a worldwide market. It trades almost 24/7, I would say, the Treasury market. But I noticed that the 2-year note yield dropped like over 20 basis points in the last half of the week. And we got down to 4.15, as you can see here. And the 10-year didn't drop as much. You know, it's almost at 4%. So that yield spread is just
Widening.
yeah, well, yeah, no, it's like narrow, yeah, widening, and it was a lot more negative, and it looks like the curve could finally disinvert. And what does that mean? Well, it disinvert means that the 2-year yield becomes less than the 10-year, and usually when that happens, when it gets to zero, it's pointing to a recession. And why is that? Well, because every time that the curve inverts and then disinverts and becomes normal, upward sloping, uh, there's always a recession historically. So I think this is, and the fact that that moved just 22 basis points in a matter of 2 days is quite significant. I mean, I traded these markets for many years, and I can tell you that a move of 22, 25 basis points in the 2 year in 2 days is like really big. What's your taking on that, Clive?
Um, it is a big move. I read yesterday that every single, well, currently the futures markets are forecasting a reduction in the Fed funds rate at every single meeting they're going to have next year. In other words, I think there's about 8 meetings. We're going to see eight
What
quarter point
this
reductions.
year? This year, you mean?
Yeah, I beg your pardon, 2024. Yes, well, I'm still in 2023, you know.
Yeah. Sometimes I have to be careful when do the introduction for the videos. Be careful saying 2023.
Yeah, so the forecast at the moment is that the Federal Reserve will keep reducing rates month after month, which is completely the opposite of what the Federal Reserve wants us to believe. But sometimes the financial markets know more than Jerome Powell.
Yeah, some people think the Fed control everything, but I don't think they do. So it will be a very interesting year. And any views on the geopolitical situation, how that could affect the markets?
Well, geopolitical situations are not new. We've always had them every year, year after year, and always will. Some, you know, it when you're in the middle of it, it always seems very, very bad. and it always looked like things could get much, much worse. But when you look back on the geopolitical situations of the past, you say, well, I got through them. I survived. I came out the other side, and they don't sound like they were that bad looking back on in retrospect. So the current one, to the man in the street, will always seem much more worrying and much scarier than the ones he's lived through already.
Yeah.
Um, so what I say to people is invest your money in a normal way. Don't rush to cash. That would be a very bad thing because you're going into an investment which is guaranteed to go down in value. Diversify your assets and keep invested in tangible things, and that would include gold, of course. But I have a wider view. I think we should own property and equities and personal possessions. I just think that it's a very bad idea to own cash in an environment where the amount of cash on the planet is likely to continue to increase ad infinitum because of the government's deficit spendings, which are not going to go away anytime soon.
Yeah, I think the geopolitical situation, like you said, it's always scary, World War III, nuclear stuff. I think we need to, calm down about that. But one thing that I think is a little different this time is that the West, under the leadership of the US and the UK, they're alienating a lot of countries that they dependent on for financing their debt. And I think that's going to continue, and that will mean that there will be less demand for treasuries, for gilts, for European government bonds, and that's going to mean higher yields. And like you said, cash is no good. Tangible assets is good. And I agree with you. I mean, I have gold and silver. I don't have much in the stock market, but I also have my house. So that's property. If I didn't believe in it, I would be renting. And I see gold and silver more as uh, ammunition, like putting money aside. And it's up to each individual to decide where they want to put that ammunition to work. And if they have an asset that they like, they need to keep track of the purchasing power of gold and silver versus that asset, and see if that's a good time to, to jump from one to the other. So, Clive, any final thoughts for the viewers before we wrap up?
Well, a very quick one. I saw in one of your comments on one of your videos, somebody asked about books that they should read. And you can see on my over my left shoulder, you can see a row of books. I'll just show it to you in a shared screen there. I hope you can see that. So anyone who's thinking of buying books and want to know what I read, that was a question I got. Well, that's the books, and you
Oh,
can
that's
take a
good.
screenshot of
Yeah,
it.
so if we pause here, if you pause the video, you can take a screenshot. And yeah, that's a good collection there. You got the creature from Jekyll Island I saw there.
Indeed, I haven't actually read that one yet. I started reading it, but
Yeah.
there's so many good things to read. I'm getting my
Yeah.
way, working my way through these books.
Yeah.
In the old days, before the internet arrived, I used to get through a book a week. Nowadays, there's so much social media hitting you. You start
Yeah.
reading a book, and then you get your telephone
Distracted.
pings, and you've got to
Yeah.
you got to
Yeah.
stop.
I just bought recently this book here. It's called The American Trap. And this guy
Mhm.
here, he's a French guy, Frederic Pierucci. He was a top executive at Alstom, French company, and he
Yeah.
was arrested for under the Foreign Corrupt Practice Act, FCPA. And it's really interesting to read this. I'm almost halfway through it. But the point of this book is that not just the sanctions against countries like Russia and others are putting people away from dealing with the US, but also uh, the US basically, under this act, has extraterritorial powers, and the OECD countries, they went along in, I think, 2001 with this corruption agreement. But the only country that has the power to investigate and arrest people is the US. So that's another reason why I think a lot of countries, even European countries, are thinking twice about holding dollars and things like that. So this is another good one. And yeah, like you, I used to read a lot more, but you get distracted. My problem is that I read several books at the same time. I ordered one yesterday, Clive, because I want to look more into Singapore. And I think it's a book called Singapore. It's by the first prime minister, a guy called Lee. So that would be interesting. Do you know much about Singapore?
I've been there. It's a very clean and lawful city. I wasn't there for very long, and the people I met were very, very friendly. That was nice. Uh, it seems like a great country to go and live in. Taxes are low as well, and I think you can get residency if you've got enough money.
Yeah, the other thing, just before I wrap up, I checked their debt to GDP, and I thought it's humongous, 163%. But then I read further, and that's their gross debt. Their net debt is actually zero. And there's a law in Singapore that the national debt, they can only borrow, the government can only borrow for projects, not for spending. So all that debt is matched by productive assets. And they've been running surpluses, budget surpluses forever. They had a 10% deficit during COVID, but I think their latest budget deficit was 0.3, and usually it's positive. So there you go. Uh, we're going to look at Singapore soon. And Clive, thank you again for coming on. And if you've got anything that you think is important, let me know. And I wish you a great start to the week.
Great. Thanks very much, Mario, and have a lovely rest of your week and speak soon.
Thank you.